Welcome back. 150 points lower on the index, now below that 25,450 mark. So continue to monitor the Nifty on the weekly expiry today. And of course, the real estate index that continues to remain the top sectoral loser in today's session. Tata Capital reported a good quarter, even with better guidance as well. Ritu spoke to Rajiv Sabharwal, the MD and CEO of the company, and began by asking him about his consolidated assets under management and the growth guidance stepping into the new year. Listen in.
If you look at our growth has been well spread across different segments of the business in which we are present in. We've given a guidance of 18 to 20% on the consolidated basis, and we would want to stay with that guidance. Whether we will be 18 or 20, time will tell. But as far as the first months are concerned, we have shown very good growth, and we are hoping that this momentum will continue because January is looking promising, and we hope as we progress towards more deeper into the quarter, this growth will only accelerate.
All right. Motor finance AUM has been on that declining trend. Two parts here. First, where are you in terms of integration and portfolio cleanup there? And secondly, when does growth here meaningfully return? And what kind of growth rate is realistic for motor finance from FY27 onwards?
So if you look at our strategy as far as motor finance is concerned, our whole thought there was that we need to transform this business and make it profitable. We have done a few things there. One, we clearly now have diversified our portfolio to have all OEMs, whose vehicles we finance. We've increased the proportion of used commercial vehicle, which can help us in improving our yield and returns. Similarly, we have reduced the percentage of heavy commercial vehicles and increased the percentage of mid and small commercial vehicles. Similarly, we've embedded a lot more of technology into the system. We've tightened the credit policies, and that is what is helping us improve the ROAs. For example, in the quarter which just went by, we broke even, and we hope that going forward, ROAs will inch up. As far as growth of the book is concerned, since we were transforming, the growth was not there. The book was degrowing, but we believe that starting in the new year, we will get back to growth in that business too.
All right, get back to growth for motor finance starting FY27. Let's also talk about your margins, Mr. Sabharwal. A 25 basis point sequential improvement to 5.3%. Of course, there was lower cost thanks to the RBI rate cut and some yield expansion as well, which helped. But, as rate cuts flow through further, or if they don't, where do you expect NIMs to settle by the end of the year? And what does a sustainable, steady state NIM look like for Tata Capital in the medium term?
So if you look at margins, our whole strategy is one, that we will ensure that our rating remains the best, which we have, which allows us to get a cost of money at one of the lowest in the market, price at which we raise our liabilities. We've also diversified our liabilities so that we look at all opportunities such that we can get the money for the right tenor and at the right price. As far as margins are concerned, we believe that we have gained in the accounts. One, because of cost of funds coming down. Two, also because we had to raise here, and that liquidity also helped us. From our perspective, we also believe it's very important for us to pass on the benefits to customers to spur growth. So we've been also passing on the benefits of lower cost on fund to customers. However, we do gain because we have a large fixed rate book also. So there we do gain. So our margins have improved in Q3 over Q2. As we move into Q4, we believe there's an opportunity for margins to get better. However, it will also depend on what liquidity is there in the market. While RBI has brought down repo rates, but the rates in the market are a function of both the action on repo rates and also the available liquidity. RBI has been proactive there. If that continues, we believe there will be spending coming on further on cost of funds in the coming quarter.
All right. Speaking of credit demand, Mr. Sabharwal, there would have been some benefits from the festive season, the GST tailwinds. But as you move into the fourth quarter and the new financial year, are you seeing any signs of demand normalization, particularly when it comes to vehicle financing and across retail, SME, and corporate? Which segments, to your mind, are best positioned to lead growth for the company in the next 12 to 18 months?
If you look at post the GST cut, there was a spurt in certain segments, especially the vehicle segment saw a huge growth. That growth continues on both passenger vehicle and the commercial vehicle side. There is some amount of moderation which has happened on the two-wheeler. We believe hopefully that will also pick up further. There's good demand on the tractors side too. All that is also helping us see more demand on the SME side because there is more demands coming in from the consumer side. Housing remains extremely strong, and hopefully all this is leading to corporates now putting in more investments, and that will further increase the corporate demand in the future. If I look into the future, the larger growth for us will come from housing. That's been the largest segment for us. We are also seeing demand on the retail secured and unsecured and the SME side. And as a strategy, we've said that majority of our portfolio, like also retail and SME, including housing, form about 87% of our book. And this proportion is expected to remain in this range.
Okay. Mr. Sabharwal, specifically on unsecured retail, last quarter you had indicated that asset quality challenges were behind and you've now started to scale up disbursements in the last few quarters. Currently, that's about 10.4% of your AUM. Over the medium term, to what extent would you like to grow that book?
So retail unsecured forms about 10.4% of our book. We've seen credit costs improve on that portfolio for the last few quarters. We saw early indicators of the portfolio becoming better last 12 months, and that has given us confidence to now further resume growth in that space. We've seen strong growth in disbursements in quarter 3, and we hope this momentum will continue in the future too. Since disbursements are growing with some lag, we will see the benefit of that accruing on the book also, and the unsecured book also growing. Our thought process is that over the next couple of years, we would like to increase this percentage more closer to about 15%. But as a strategy, we will continue to watch. We want the portfolio quality to be good. In case we find any challenges, we will make the necessary corrections. But the way it looks like, and with all early indicators that things are very good, and over the next few years, we would want to take this percentage up to about 15%.
Right, that's the management of Tata Capital. With that, we'll take a short break, come back on the other side. Market technicals with Somil Mehta of Mirae Asset Sharekhan joins in for a view on the indices.